Hi, everybody, and welcome. Welcome to today's webinar. While we're waiting for everybody to come in, please do just let us know where you are dialing in from. My name is Ed Croft. I'm currently here actually from Oxford, and please do, you'll find the chat interface in the sidebar. And if you just type a comment there, let everybody know where you are dialing in from. It's always good to see there's often people coming from all over the UK and all over the world. So Stockopedia has a global reach, and we have a large proportion of our subscribers from all around the world. So I'm really interested to see where everyone's coming from. Have you got any, are there any, Matteo Scalvo. Where are you from, Matteo? Fahim from London, Somerset, Surrey, Sevenoaks. One of my colleagues works at Sevenoaks, comes from Sevenoaks. Denmark, excellent. We've had a great Danish contingent lately. Scotland, Bewley. I was born in Dundee. Great to see some Scots on. Australia, Anne, welcome. I'm married to an Australian. I love Sydney. And Keith from Hockley. Brilliant. Thank you so much. Canadian. We've got Oscar from Canada. Great to see people from all over. And I do want to sort of say that everybody is welcome here. Another Dane from wherever you are in the world. Stockopedia has global data, and actually it's getting more global as the year goes on. Lars, Brian from Spain. I'm presuming, Brian, you're expat out there enjoying the sunshine. Okay, listen, we're going to start now. I'm just going to introduce myself. My name is Ed Croft. I am the founder of Stockopedia. Really delighted everyone's joined us. Great to see there's more than 100 of you on the webinar. I'm going to be doing this webinar about how to pick stocks with a high probability of outperformance without relying on tips and rumor. Now, this is something that I know an awful lot about, and I'll be explaining that through the next hour or so. Now, just let me try and find my slides. I've managed to already have a technical issue. Let me just put my slides back up. Okay, here we go. Right, this is really unsatisfactory. There they are. You can see them now. Okay, so how to pick stocks with a high probability of outperformance without relying on tips or rumor. Okay, quick disclaimer before we get started. If you know me, you know Stockopedia, we are a service for DIY self-directed investors. If you need a financial advisor, do go and find one. You'll find there won't be advice in here, but there will be a lot of education. We provide tools, history, education for investors to be better at being self-directed. So that's really important to know. Obviously, there's going to be some past performance in here. I do have to say, past performance is not a guide to the future. I like to think the future rhymes with the past, but obviously stocks go up and down. Anyways, this webinar, I'm hoping I will get through it all in about an hour, but there'll be time for Q&A afterwards. And who's this for? Well, really for two sets of people, really in particular, seasoned, experienced investors who want to save time and effort in their stock research process. If you use spreadsheets, you read company accounts, you go dive deep into the data to get your ideas, there may be ways that you can speed up your research process, and some of the things I'll be showing you today should help with that. We have many thousands of very, very experienced expert investors use the site. Many ex-fund managers like me, many very experienced people, and people who've got the most incredible ability way beyond mine use the site. So you're very welcome here. And the other thing is novices. And I've been a novice. I'm very aware of the troubles that novices can get into in the stock market. They do say sometimes that, the smart money takes from, the less smart money in the stock market. But the tools and the ideas that I'm going to be presenting here will help even novices get a much more disciplined, proven process for validating stock ideas and tips. So please do, I will be giving you some really incredible things to help you in your process. So my goal for this webinar, and many of the ideas behind what I'm going to be talking about are about factor investing, which is a very broad term I'll be explaining shortly. And really, it's the one sort of true path to consistently selecting high probability stocks. Now, people do factor investing in lots of different ways. And if you don't know what that is, I'll be explaining it. But the simplest way to effectively practice it is using this system we've designed called the StockRanks, which I'll be explaining in this webinar. It's a proprietary system of fundamental and technical analysis, which makes finding and validating stock ideas much, much quicker. And it's been very effective in the UK and globally. Now, just to say to anybody who's an international investor, you will see some predominantly UK-oriented graphs and things in here, but we do have coverage of North America, all of Europe, Asia, Australasia. We're going to be adding Africa and Latin America and Southeast Asia through this year. So do stay tuned. And, as I said, we're really, really pushing out to make this completely fully global. So do beware that there are some UK-centric ideas in this, but it's all very applicable internationally. So I'm Ed Croft. I am a chartered financial analyst, co-founder and CEO of Stockopedia.com, head office here in Oxford. We also have an office in Bangalore. And I come back to Oxford where I was a student, and I cut my teeth in the city at Guinness Marn, at Goldman Sachs in private clients before branching out on my own, running a private fund, and then eventually setting up Stockopedia, which is great fun, a huge passion project of mine. And I think you'll see my enthusiasm for it. But also the kind of the fantastic products and services we actually are creating. Now, I'll just take this back, and it's been a bit of a personal journey because this whole thing began when I was running my personal account, and I was in very heavily in 2008, before the financial crisis. I was kind of very heavily in a certain number of stocks, just a few stocks, and they were actually very China oriented. I know that we have these coronavirus kicking around at the moment, and we have some sort of worries in China and so on. But back then, China led this financial crisis, and I had a very, very bad year, losing a large proportion of my portfolio. And that triggered me to completely reassess my process. There was me, sort of Goldman Sachs trained investor, still able to make what really I now know are rookie mistakes. And, that was even by the time I'd got to sort of, 30. So anyway, what I did is I went on this huge reassessment of process. And I did it with my co-founder and great friend, David Brickell. And we searched for a way to have more consistency in our stock selection process, with a higher probability of selecting winners, lower probability of selecting losers, and ultimately to have less attachment to my holdings. Al, Raz, there are going to be some questions coming through. Al, I can see you've asked, can you put a percentage range on high probability of success? Well, I can actually, and I will later. So I'm going to answer questions at the end. If you do have questions, please do say them into the chat box. They will be flagged as a question by Sam, who's on the webinar with me, and I will try and answer the majority of them later. So if I miss a question while I'm rattling through the slides, please do keep going. But it's this emotional attachment to holdings which really gets us into trouble. Got me into trouble. If you buy a share, you tend to find that you learn everything about it, and it gets very, very hard to let it go because you honestly believe that share is going to go, in only one direction, the one direction that you think is certain, which is up. And that happened to me in 2008. And I'll tell you about one of the shares I owned. Was at £1.45 when it peaked. I'd been buying it from sort of 40p, and I had a huge position in it. And eventually it started going down, and I couldn't cut it because I believed it was going to £6. I eventually got out for 60p, and a year later it was at 1p. So that pretty much tells you the story in the stock market. You shouldn't get attached to your holdings. Anyway, this multi-year research project, I'd always been reading a lot of the classic investment literature on stock picking. And in fact, I think I've got one of the best libraries of stock picking books in the UK. It was seeded from my own library, but in the office here, we have hundreds of stock picking books. And so it started from mining that classic literature, and then also going deeper into all the references of the academic papers. Now, financial academia is a goldmine of insights into what works in stock picking. And it's part funded by hedge funds, part funded by academic institutions. And there are hundreds and hundreds of papers which have been written, as I'll be telling you in a moment, from the 80s onwards. And this came to this understanding, and this idea that there were certain traits in stocks which could be predictive of future returns only became known as factor investing later. But the papers were being published throughout multiple decades proving that this was so. And really what happens is that these factors go into certain buckets. I like to call the main buckets quality, value, momentum, as well as volatility. But we've designed our ranking system around these three core ideas: quality, value, momentum, which we sometimes call QVM. And I'll be explaining this a little bit more in a bit more depth. And the implementation results of factor investing. This is a chart from the UK market. You can go on and look at this on the site, which is tracked daily on the site. This is a chart I'll explain in more detail later, but the green line at the top is the top 10% ranked shares for their quality, value, and momentum, tracked over the last 7 years. And the performance is up 178%. That's almost 16% annualized. Whereas the bottom line is the worst ranked according to these factors, which has declined by almost 70%. The blue line in the middle is the FTSE All Share, the main index. So you can see this dramatic outperformance that factor investing has actually been able to achieve. I know that actually, as it's difficult as the years go on, the longer that we run these systems, people will look at the charts and go, "Oh, well, that's remarkable. Is that true?" And all you've got to do is go onto the site and actually see our survey results and talk to the investors who've been impacted, who've been designing their systems, their own personal investment process, using assistance from things like the StockRanks, to see that there are many people that have absolutely multi-bagged on the site using the service. Now, that's not to say that stock market investing doesn't come with significant risk. Stock markets decline. We're seeing a decline in the markets with coronavirus, and things don't go straight up. So I don't want to pretend that there's something which just goes straight up forever. Equity has risk. But this is an illustration of some of the results of these ideas, and they're totally backed up by all the academic research. So the other thing with the implementation results of all our research is that we basically gang together with other investors and put the site and the service together. And I'll explain more about that in a bit. But there's this beautiful online application. We've got more than 10,000 subscribers, and from all over the world, actually, from 100 countries. The last time I looked was 100 countries. And it's a beautiful sort of environment for doing your stock market research. It's not a trading platform. It gives you all the research, community, tools, and insights that you need to do better in your investing. So if you do stay around to the end, I want you to know that I will be giving you a really, really easy and lower risk on-ramp to Stockopedia. At the end of it, I'll be providing an offer, and you can go on and take an absolutely no risk way into using the service. And because I know that that when you're getting started, it can seem like paying for a service like this can feel like an added expense you're not sure of. But the value of it is extraordinary, and I do recommend that you stick around and have a look later. So before we go, and I'm going to go and show you the Stockopedia service in detail after some of these slides, because I want to elaborate on some of these ideas, because this whole framework of thinking about how to invest and the trouble we get in is very important to go over. So first of all, how do we get stock ideas? Where do private investors often go wrong? And I know this from experience and also my research. So we tend to get our stock ideas from 4 popular idea sources: press tips, broker recommendations, so the analyst recommendations from the city, from bulletin boards or our friends, and sometimes from conferences where we might see companies present and sort of CEOs present. Now, each of these has got certain problems. I'm going to have a sip of water because I've got a little bit of a hoarse throat. Hang on. Now, I've been analyzing these sorts of idea sources for many years and gathering bits and pieces of information about them, because in my experience and even academic research knowledge and understanding is that these are all rather ineffective ways of getting stock ideas. So press tips of the year are often very, very poor and often underperform the market. Not always, but actually more often than not. And you often see these sorts of declines or underperformance versus the benchmark. So and I'm looking at national newspapers, often investment magazines, etc. And it's been shown again and again that tips of the year is a pretty dangerous place to put your money. There is a famous example of a monkey with a dart that can actually outperform all the tipsters in the press. So, the thing is, journalists who write tipping columns often aren't professional investors. They aren't actually practitioners, and therefore they often have slightly biased ideas towards big brands or popular stocks, etc., that often underperform. The other thing is broker recommendations. Now, this is much more surprising. And we did a study of 3 years of all the buy, hold, and sell recommendations that the brokers or the city analysts actually promote. And we found, and this is using the Thomson Reuters estimates database, which had 3 years of data across thousands of stocks. And we found that buy recommendations actually underperformed the sell recommendations. There were a lot more buy recommendations than sell recommendations, but still it was quite a remarkable insight. Now, that's not to say that analysts and brokers don't provide a huge amount of value in their research, but their recommendations aren't necessarily as reliable as one might think. So when you see a broker that says buy, I often think you should take that with a pinch of salt. Popular bulletin board stocks, again, I've studied this over multiple years, and again, you find the most discussed, most risky shares that bulletin boards often talk about have significantly underperformed the market. This is a few years old, this one, but I do update these every now and then. Lots of questions coming through. I will answer them later. And conference exhibitors. Oh, this is one of the most remarkable ones, is that if you go to a conference, you're going to meet CEOs and they're going to be very charming. They're going to be really bullish about their stocks. And you tend to find that the companies that exhibit at exhibitions underperform the market. Now, why does this happen? Well, it's very, very simple. The companies that pay for PR, and PR in all kinds of ways, companies have investor relations budgets. They'll go out to exhibitions and put up a stall. They'll also pay for research and for press and media to promote those stocks. So they'll have news stories written about them. They'll have exhibitions done about them. And the companies that pay for this sort of IR are often the ones which actually need investor cash. They've got to get investment into the company. So they've got to promote the shares because they need to do a placing or a share issue or whatever. And what you tend to find is that companies that do the most PR tend to underperform because they need capital. The best companies don't need extra capital. The best companies generate capital and they don't need to go and do lots of PR and investor relations. So what happens is the companies that do all the PR, you get all the stories in the press, and then you find basically that private investors will start talking about them on bulletin boards, etc., etc. They'll get tipped in the press, and it's just really, really negative. It's a negative media environment for private investors. And I think that's a key insight. And something, when it clicked for me, I realized actually that was a way that I could really, really sort of change the way I focused on my investing. Not to say that all information is bad information. There's lots of great information. There's lots of very, very wise investors out there. But in aggregate, they often aren't. And really, it comes down to us being suckers for stories. We have this sort of narrative fallacy in the mind. You think about Odysseus on his journeys, if you remember from the Odyssey, and he went past the sirens, these beautiful, I think they were mermaids, weren't they? And they would sing, and they would sing ships to shipwreck because the sailors would actually want to go and basically go closer to the sirens, and then their ships would wreck and they'd die. And Odysseus got all of his sailors to basically put wax in their ears, but he really wanted to listen to the song, so he got himself tied to the mast. And he listened to the song and it tortured him, but his ship didn't get shipwrecked. I mean, really, we are all, and that's a story that's been around for thousands of years, but still we don't learn from it. When there are stories, we get drawn in and we expect a Hollywood ending. It's the natural impact of a story that is unresolved. And so every stock that you own, you'll be thinking about the Hollywood ending. And the Hollywood ending is what gets you into trouble, because ultimately reality isn't a Hollywood ending for every stock. So all of these sort of environment creates a bit of a poor process. It creates poor process endemic across us as investors. And that leads to poor performance. And almost every study of private investors shows that we tend to underperform because of this poor process. There's been lots of studies of brokerage accounts in US, Taiwan, actually in Denmark, in all around the world, that shows that private investors often significantly underperform. So one has to take the advice from John Templeton. If you want to have better performance than the crowd, you must do things differently from the crowd. Templeton's a very brilliant investor, and he's just talking plain common sense. And I talk to our subscribers all the time about this and ask them, what's the difference a service has had in your investing? And you tend to find this, because because our service adds a lot of rigor to people's investment process through the data and the factor investing tools, people say that that's the main transformation they see. So you see people like James here said, I used to take a very unstructured approach when picking investments. He'd use tips from financial publications, etc., and returns being mixed. John saying his previous approach was haphazard, using a mix of sources like the magazines and the internet that were contradictory, and he often ended up buying companies with recognized brands or high profiles. It's the classic way we often just go, oh, I don't know what to buy, I'll buy the one I know. And then Nick saying, he had a fairly difficult process looking at the press and tips, not structured, never fully confident. And I think if any of that rings familiar with you'll see that some of the journeys these investors have been on with us as their sort of a sidekick has actually really made a difference and built in so much more rigor and confidence into their process. So now I want to have a quick aside and talk about what really pays off and why in markets. This is really a radically simplified sort of model of everything that we discovered in our huge research project into what works in investing. And these ideas are now a bit more widespread, but we were one of the first places to actually bring them to private investors. So I want to take it back a little bit and put a timeline in place to give you concepts about what factor investing really is. Because way back in the early 1900s, there was this chap called Jesse Livermore, who was this absolutely remarkable trader. Now, this is before there was standardized financial accounts, before there was really any literature on what works in stock markets, but stock markets were all abuzz. And Jesse Livermore somehow figured out by reading the tape, the ticker tape, which used to come through the machine with all the prices of all the stocks on it, he realized that when shares broke out to higher prices, he could buy them, and more often than not, they would keep going up. And this was the genesis of the idea or concept of momentum, which is the breakout shares or the stocks that are leaders in the market have a tendency to keep rising. It's very counterintuitive. We always think we've got to go to the bargain bucket to find good stocks, but actually he found you bought the ones that are going up the most tend to keep going up. Now, he actually shorted the great crash of 1929. He made a fortune through that period. Unfortunately, he loved risk so much. He actually ended up, I believe, going bust, and he shot himself to death. So not a good outcome for him. So if you do go and take more kind of momentum angle in your trading, remember that it can be more volatile at times. But after the great crash, Ben Graham, who was a professor, he got very, very burnt. He lost a lot of money, and he thought about it all very deeply. And he realized he never wanted to be burned ever, ever, ever again. And he started writing this book called Security Analysis. It's very, very heavy, very dry. But he put in there lots of methodologies for investing with a margin of safety in stocks that were so cheap that you couldn't lose your money even if they went bust, because you could just sell off all the parts and you'd still win. This was the classic bargain bucket investing, or deep value investing. And it was the first time it had really been written down with any rigor. So he started teaching, I believe at Columbia University, a whole swathe of people that would go on to be the best fund managers over decades. And one of those was the esteemed Warren Buffett, who probably needs no introduction. You'll probably know him as the greatest investor who ever lived, the richest investor who's ever lived, etc. But what Buffett did is he soon realized that only buying cheap shares actually gave you lots of sort of distressed stocks. So he, with his partner, Charlie Munger, started to think about ways that you could offset that. And they started buying franchise stocks or high quality shares at a higher price than just cheap. So more inexpensive, higher quality shares with great profitability, great cash flow, predictable earnings, stable businesses, and scalable businesses. And these three key ideas of quality, value, and momentum, these practitioners and many others like them started putting to work in the market. But there was no sort of, it was all sort of seen as an art form. It was all seen as only done by these great heroes of investing until the 1980s, when databases and computers started becoming more popular. And they started becoming more affordable. And people started putting financial data into databases and actually analyzing the output. And this is when the academics got involved and looking at long-term historic stock returns. And Eugene Farmer and Kenneth French, a couple of guys you may never have heard of, they basically did a massive analysis on US stocks, and they talked about this thing called the cross-section of returns, and they analyzed and broke up the market into lots of different buckets and proved that just buying all the cheapest stocks in the market as a bucket outperformed the market as a whole, and also the most expensive stocks. And this became known as the value factor. And they did this in a variety of ways, and their techniques were replicated by other academics like Jagadish and Tietman, who did the same thing, but for all the basket of shares that were rising, buying the top shares that had the strongest strength, and proving that they as a class outperformed. And that was done again and again and again in more and more academic papers, including by Robert Novi-Marx, who analyzed quality and found these quality metrics worked as well, and actually started analyzing quality, value, and momentum as a whole. And this explosion of academic understanding actually was the birth of what is now known as factor investing. But ultimately, factor investing, or investing in stocks according to their traits, their fundamental and technical traits, has been going on, as you can see, for 100 years. It's just moved from being sort of artistic practitioners to more rigorous analytic investors. And now hedge funds do it, et cetera, et cetera. And almost the last to do this are private investors. And that's something that's really where we come in. And what we realize we could do is we could help investors by sort of democratizing, as computers get cheaper and the data becomes more widely distributed, we could actually bring these sort of ideas to private investors. So what I did is with my founder, we found lots of private investors who wanted to back this idea. And over the last 7 years, we put in £3 million of investment to try and deliver this sort of high quality data and insights in a really easily understandable way to private investors. We've now got more than 10,000 subscribers. And at the heart of it, we pull in very, very high quality institutional data from Refinitiv, which is the data business of Thomson Reuters. And we crunch it every day, every night. We clean all the data. We have all kinds of processes which make the most accurate fundamental database, I believe, anywhere in the world online. And I obsess about this. I've got lots of CFAs here who all are obsessed about data quality, because that's then what creates our ranks and our screens and all the output of this sort of machine. Now, there's so much to this. We've got so much on the site, and I'll show you a little bit. Adrian, I think we're getting stories here. Maybe you are. So one of the key USPs of the site is known as the StockRank. And this is our very effective ranking system for stocks. Every stock in the market is ranked against all the others for these three proven historical drivers of return: quality, value, momentum. And you think of it as good stocks, cheap stocks, and strong stocks. And we rank these shares, and we publish these stock ranks on every stock report. This is one of Rightmove, and I'll show you this later on the actual site. But you can see up here, top right, the stock ranks are published in the top right corner, QVM, and they are ranked from 0 to 100. So 0 being poor quality or expensive or weak momentum, and going up through the percentiles to good, profitable, cheap valuation, strong momentum. So, and the overall stock rank itself is a composite of all three of those subsets. There's actually, I'm going to go into a bit more depth into how we calculate these things in a minute, but that is the sum of that. And actually on these stock reports, we've also got the history of the stock rank. We've got some other great features based on the stock ranks. You can put them in tables and everything else too. There are more questions coming through, and I'm going to come back to it in a minute. But ultimately, the rank goes from 0 up to 100 is best, and there's always 10% of the market in each decile. So 90 plus, that means it's a top 10% ranked share. 100 is a sort of the highest ranked share in the market, 0 being the lowest ranked. So it's a very, very easy to understand and quick measure and sort of litmus test on a share as to whether it's exposed to factors that have worked in the past. Doesn't mean it's going to shoot to the moon, but I'm going to show you some of the probabilities based on these numbers in a minute. So before I do, I'm going to show you a little bit more in depth about what I mean by quality, value, and momentum. And after I've done that, I'll go onto the site and I'll give you a demo of what's going on. So quality is the idea that quality beats junk, profitable stocks beat junk. Value is the idea that cheap beats expensive, and momentum, strong leading stocks beat weak laggards. I'm going to start with value. There's the sort of the Ben Graham concept that cheap stocks outperform expensive stocks. Now, how do you value a company? And if you know your finance, if you're more experienced, you'll know there's really two ways of doing it: intrinsic valuations or relative valuations. We focus, because this is a ranking system, we focus on relative valuations. I'm sure that most of you will be familiar with a P ratio or a dividend yield, and these are factors or ratios or factors which we can use to value a company. So we like to look at what the price of a share is against what the company earns, what it owns, what it sells, or what it pays out, using a variety of different financial metrics. Now, one of the things that puts off private investors is that they haven't necessarily done a CFA. They haven't necessarily read all the books. They often will look at things like a price to book ratio or a price to cash flow ratio or an earnings yield, and they'll be terrified. They don't know what it means. And I think this is really, really a terrible jargon that comes from the city and Wall Street to put people off and to confuse people and make them invest based on stories. Whereas actually the underlying insights from these financial ratios are very straightforward if you can learn to interpret them. And one of the great benefits of the value rank is that it actually normalizes all that data into something that anybody can understand. Now, cheap stocks can have problems, so I'm not saying go out and buy the cheapest shares at all, but having a measure of relative cheapness is very, very, very valuable. Yes, Dave, you can screen for price to tangible book value. I'll show you a little bit more about that. And you know what? This is a very introductory webinar. And if you want a lot more detail, I have some fantastic longer webinars that you'll be able to find on YouTube and on replays on the site. So, there's lots more depth into stock screening, into analyzing stocks individually on the stock reports, and more on the site. But anyway, how do we create the value rank? Well, if you imagine that we take a PE ratio, price to earnings, the price of the company against the earnings of the company, and let's say it's got a PE ratio of 3.2. Now, most investors might know that that is a low PE ratio. And if you normalize that, if you rank it against all the other stocks in the market between 0 and 100, you'd find that this share might be cheaper than 94% of stocks by its PE ratio. So it's a very cheap share. Now, it might have problems, but it's cheap by its PE ratio. Doesn't mean you should buy it. And if you take a more normal PE ratio, like say 18 times, that might be more ranked in the middle, whereas a share on a PE ratio of 67 or 100 or even more will be ranked very, very, very low. It's cheaper than only 4% of stocks. And we can do this. What we do is we take a multi-factor or multi-dimensional analysis on a share to create a value rank. So we look at each of these financial ratios and we rank each stock for each of them against all the others in the market. So the P ratio, price to cash flow, dividend yield, the earnings yield, the price to book, the price to sales. And you can see here all the relative rankings, which are all normalized between 0 and 100%. And that would create a composite value rank, which then becomes a percentage out of 100. And that becomes the value rank you see on the site. So it's actually on the value rank, there are 6 inputs like this. And I'm not going to go into the details of the other ranks in the same way, but that's pretty much the process that's going on underneath. So we make sure the data is really clean, we rank it, and then we come up with this great sort of ranking, which gives you a litmus, sort of a quick, easy way to understand the relative cheapness of a share. Now you can see what I've got on these bar charts is I've got the rank, this is actually mislabeled, but it's the value rank along here with 90 to 100 bucket here and 0 to 10. So the most expensive are down here. Cheap stocks against their earnings or assets or high yield shares are up here, and lower ones are here. And this is the annualized return. This is the UK market over the last 7 years. So you can see it's not a perfect bar chart, but you can see that expensive shares don't tend to outperform, and cheaper shares have a tendency to do better. Now, the very cheapest bucket did best, but it comes with added risk. Now, if you want to separate the risky shares from the less risky shares in the cheapest bucket, how do you do it? Well, you start measuring the quality. And the quality rank is the idea of good stocks outperforming junk stocks. So we assess quality, and I'm going to breeze through this, but we look at whether it's a good business. We have actually a lot more factors that go into the quality rank. We look at its profitability across its return on capital over the long term, and its current return on capital. We look at margins, free cash flow, and we come up with a composite measure of its profitability. We also use something called the F-score to check out whether the fundamentals are getting better or worse. So you can see the trend in the fundamentals. And we also look at certain red flags to look at bankruptcy risk, earnings manipulation risk, and others to try and make sure that it's safe from those sorts of extreme risks. And they all come together into the quality rank, which you can see actually has an even more impressive spread, with the higher ranking shares, the more profitable shares, actually doing about 12.5% annualized over the last 7 years. You can see the lowest ranking, the lowest quality shares, the ones I'm saying, which are probably out there at all the conferences, all those sort of, especially could be lots of energy and mining stocks, which have actually declined by 14% annualized over that period. So you can see that focusing on higher quality names in the market tends to lead to better results. But most people don't have a measure of quality, and that's what the quality rank gives you. It gives you a quick litmus test of what is good quality and what's not. Lastly, the momentum rank. This is something which most people object to. And the thing is, Farmer and French, those academics, said that the momentum factor was actually the king of all the factors. It's been proven again and again that momentum actually beats value in the market. But all of us are for some reason trained to be value investors because we like going to the market and buying bargain shares, etc. Sorry, bargains in the market. It might be a bargain, you find in the supermarket. It might be any market. But you're trained to go and find a steal. You want to buy a house on the cheap, But the thing is, actually, what works in stock markets is the other way around. Shares that are going up tend to win, and they tend to win dramatically. I always bring up this case study, which is by David Stevenson in the FT. And he wrote this about us way back in 2013, when we just launched the first version of the site, which was way more sketchy. We put years of development into the site now, and it's so far advanced. But he was talking about how to use stock screens or data to net the shares that get away. And he said one of his big regrets was not having bought into a small UK-based transport group called Dart Group. We might look at Dart Group later. It's actually come off a bit now. This was in 2013. He let it get away. And this was when he wrote about it in 2013, and it had already doubled. So he was like, I've missed it. I can't possibly buy it. But the thing about momentum is buying winners often means that the only way a stock can be a multi-bagger is if you buy shares that are at new highs and continue to go up. And this share actually ended up going up miles and miles and miles. And actually last year it had a standout year again. It was up another 100%. So it's something that we need to train ourselves out of, this tendency to not want to buy shares that are going up. If you buy quality shares that are going up, it's often a way to do quite well. Obviously, you want to buy them at a reasonable valuation, but these are important traits. Okay, Sam, you got a question there, and I'll answer it in a while. Now, this is the momentum rank performance, and this is, and you can see an even more sort of beautiful trend here that higher momentum shares have tended to dramatically outperform lower momentum shares. I'm going to have another little sip of water while you take that in. Now, our measure of momentum actually uses the price trend and what's called the earnings trend. It's a bit out of scope of this webinar to talk about that, but it's a combination of price momentum and earnings momentum. But generally, this just shows you that the stock and the company are heading in the right direction. And that's an almost 14% annualized return for the highest momentum shares in the market. And the overall stock rank itself, which I like to call QVM, it brings all three of these ideas together. So good quality, cheap valuation, and strong momentum is the highest ranking by the StockRank, and that tends to beat the junk or expensive weak stocks, which are the other side. And that's done even better. You can think of this as a Venn diagram. I show this a few times. You've got the quality rank here, the value rank here, and the momentum rank here, and the QVM being in the middle. If you do go on the site, you'll learn about things like the VM rank and the QM rank and the QV rank, which you can also think of as being the intersection in this Venn diagram. So we create actually unique ranks for value and momentum, which actually exclude quality too, but that's a bit more advanced. So QVM's in the middle, and I want to show you some of the performance and hit rates of the overall stock rank itself, which has actually outperformed the quality, value, and momentum ranks themselves. So the way that I do this is, imagine you take all the shares in the market and you stack them up according to their stock rank, with 0 here and 100 here, and you rank them all like that. And then you have increasing quality, value, momentum as you go up that list. And those dots are just, think of them as all the stocks stacked on top of each other. If you split them into 10 buckets, or which I call deciles, you can then track each of those little buckets as a portfolio over time. So if this is just the UK market, you'd have about 180 shares in each bucket. If it's all of Europe, it might be more like, I don't know, I forget how many there are in Europe, but it might be 800. And if you track the performance of that over time, this bucket you can see as a portfolio, and you rebalance it along the way to keep it in those top ranked shares, you will come up with a variety of performance charts like this. Now, when you see a chart like this, that's what we've done. We've created the deciles and we're tracking them over time. You will build the portfolios here, hold them for a quarter or a year, and then rebalance them into the highest ranking shares or the lowest ranking shares, depending on which bucket it's in. And that's how this chart that I already showed you was created. And you can see it on the site. So that's 178% return there for the top ranked shares. That's a bucket of 150 shares. This actually keeps the lowest market capitalization shares out. So the real tiddlers, 10 million market cap and below, are not in this chart. If we added them in, the highest ranking set actually performed more than 200%. If you go and you raise the market cap bar so that you actually look at just, say, large caps, you would find that large caps have not done nearly as well, but there's still been a spread. So I forget what it is, but it's probably more like 50-60% over that time frame. I forget, but you can find it on the site. So that gives you a bit of an indication. And you can see in this bar chart, again, it's not a perfect distribution, but the highest ranked 90 plus shares have returned about 16% annualized over the last 7 years in the UK. Now the thing is, and somebody said earlier, actually no, Dave, that's without dividends. So an important point on those charts, Dave was saying, is that the share price growth with dividends? No, it's not. It excludes dividends. But because there's rebalancing in those charts, there would be transaction costs in a real portfolio. Actually, you find in the top ranked set, there's normally about a 3.5% dividend yield, which would be added on top. But if you were rebalancing, it would be removed too. So there's a bit of a trade-off there. We're hoping to actually add in dividends into our tracking in the next year or two. So this is somebody said, can you actually quantify the probability? Now, Ollie, who works with me, is CFA, and you may talk to him. He does outstanding work here. He actually analyzes the hit rate of picking winners in each of these stock rank deciles. And what we've done in this chart, this chart, I believe, is from last summer. So it doesn't include the latest rally in the markets. I know there's been a bit of a decline lately, but generally the stock rank bucket has gone up. So this, I'm sorry, I've got a very tickly throat. This chart has been created by looking at all the shares in each bucket, holding them for 1 year, and then seeing how many were winners and how many were losers. So if you see over here, this is the 90 to 100 ranked set of shares. And on average, in the average year over the last 7 years, there's been almost a 2-to-1 likelihood that you would pick a winner if you bought a 90 plus ranked share. So 1 in 3 or more, slightly more than 1 in 3 was a loser. So just because a share is ranked 99 doesn't mean it's not going to go down. It's a probability distribution. And again, I can't guarantee that these stats are going to work going forwards. So, as I said, the future may not be like the past. And this is what's happened in the last 7 years. And I would expect over the longer term, maybe some of these to sort of normalize a bit. But what you can see is that low ranked shares have more than a 2-to-1 against distribution of picking a winner. We've got bags of statistics on this, and I once did a 2.5-hour webinar, not a 1 hour one, about all of this information, because we've got way more detail on this. And you can see that really, if you go and look at your shares in your portfolio and you find they're all ranked sort of 0 to 40, you know that you've got quite long odds of beating the market, because you're generally in a bucket of the market where there are mostly losers. So I always say the thing about factor investing, there's no guarantees, but if you generally buy higher exposure stocks to these concepts of quality, value, and momentum, and you diversify your portfolio, you're giving yourself better odds of beating the market. Because you don't need better than a 50% win rate to actually start significantly outperforming the market. If you only buy 3 or 4 shares and you only bought 90 plus stocks, it's quite possible you could buy 3 or 4 shares just in that red bin of losers. And it does happen sometimes. I sometimes get somebody writing in and saying, oh, I've had a really bad year. I bought 2 shares and they both had a high rank and they went down. And that's just the law of numbers, I'm afraid. I tend to buy 20 shares in my portfolios, and there's a whole column I've got called the NAPS portfolio on the site, which is about buying 20 shares, 2 from each sector, and it's doubled its money in the last 5 years. So, and generally you find that there is about a 60% win rate in that portfolio. Some are bad losers, some are winners. So that's a really, really important key point. So as I'll show you in just a minute, I'm going to go onto the site. It's not just about the StockRanks. There's so much more data and rigor on the site. But before I go on, I want to show you some of the stories and the outcomes of when people do use some of these ideas in their investing. As James said, he makes decisions that are far more grounded in data, and with the insights from fellow investors on the companies that he's looking at, the StockRanks are a strong component of investment decisions. His results have improved. He's more confident in his decisions, and he beats the indices. John now maintains clear records and reasons for purchases, and he screens according to lots of our proprietary data, sectors, stock ranks, risk ratings. I haven't talked about the risk ratings. We've got these fantastic risk ratings on the site. I'll briefly show you that later. And generally people talk about the more rigorous and more confident process and the ability to make better choices and more consistent returns. So that is really one of the key fundamental value propositions of the site. So I want to go onto the site, show you some ways to use it. Like I said, do stick around. I've got a good offer for you all if you want to get started at a very low risk way on the site. I know the markets have been coming off. There are more opportunities possibly at better valuations than there were, but who knows what the market will do. I always like to say I never predict the market. People always ask me for stock ideas, and I say, look, I'm a systematic investor. There are lots of stock pickers on the site. Once you start talking to them, you'll find out that you can find some of the very best investors on the web on the site, and you'll see they're much wiser than I, individual stock analysis. And I'm much more of a systematic investor because I've learned it suits my investment process. Now, what I'm going to do is I'm going to try and load up Stockopedia and share my screen. And I'm going to try and just focus this on the application window. And I'm going to try, I should have prepped this and actually logged in before I came on, but let me just log in. And hopefully, so the application loads up in the browser. It loads up also on your phone. We've got a wonderful phone version of it, and you can so you can access it absolutely anywhere. You know, you're not tied to a single device. You can access it at work. You can access it at at home, etc., etc. And it comes. What you'll find is as soon as you log in, you get presented with the Today page. Now I'll come back to that. But one of the first things I wanted to do is show you, and just for example, just bring up a share. And I'm very happy to take some shares and show you what I would do. Oh, that we've got a new version of the site. Hang on a minute. Got the developers are always developing new features, and so you regularly see that they ship new features, and we get this notification that they've delivered a whole bunch of new features on the site. So anyway, I'm not sure what they released today, but it's good to see they have. So Rightmove. And one of the first things I can see, if my internet connection is not poor, is the stock ranks up here on the right. Overall stock rank of 82. You've got the quality rank of 99, a momentum rank of 99, and a value rank of 6. So I can see at a glance that it's a expensive share. It's got low value rank. It's very high quality and very high momentum. Okay, you've got the picture of the share already. The other thing I like to look at up here is what sector it's in, technology. It's a conservative share. I was talking about our risk ratings, and this little word here is super powerful. You can learn more about it in our online learning, but you'll see some shares will be called highly speculative, and this is a 5-graded risk rating for the share. So this is a conservative, highly ranked share, large cap, and this is a style classification called high flyer. This is one of 8 classifications of shares based on the StockRanks. I'm not going to go into the details now, but if you do sign up, you'll be able to learn more. You also can see that the actual StockRank history is here under the chart. So we've got a price chart, and you've also got the StockRank history. You can see that it was 82 then. If I go back 5 years, you can see, oh, back then it was in 2016 it was lower. But anyway, there you go. It's very full featured. Lots of information on the stock report. I do entire webinars about this. I was talking about the financial ratios. These are the little, what we call traffic lights, which show you in a visual way the ranking of that ratio against the market, industry, and the market as a whole. So you can instantly see if they're red, it means it might be a negative. If it's green, like here on the quality metrics, they are very, very, very positive quality metrics. So, and you can even see things like shareholder activity, whether institutions are buying it, whether the community's buying it, and whether directors are buying it. There's so much on here. I'm not going to go into it all, but as you go down, you'll see it's a really beautifully laid out page of all the essential financial statistics. Sam, you're saying if you've already had a Stockopedia trial, I will make the offer still available to you. I was talking about the red flags. I always eye these. It shows the health trend, the bankruptcy risk, and the earnings manipulation risk. This stock doesn't have any red flags, apart from the fact that it is really quite punchily valued. It's quite expensive. And as we go down, you know, there's so much to get involved in here. You can see the broker forecasts. You can learn about the company. There's the profile summary, all the directors. You can even go and get links to the company website where you can do your own digging, etc., etc. And that's not all we have. We've got full featured technical charts. We've got all the accounts. You've got major shareholders, directors' dealings, financial statements. We've got some great tools, like you can run it through checklists, you can catch up on your news, and you can find discussions. And it's a full featured stock report that is one of the, this is my, as I said, it's a huge passion project. I sweat the details. I've got the team sweating the details, and I just love what we do. Anyway, you should check your stocks. Occasionally, if you find, no, we don't have any ESG ratings, Justy, but we might do in future. But there can be all kinds of shares which, you know, you may know, which actually have very low rankings. And if you go and load it up and you find that most of your shares have low rankings, you might be thinking, well, where do I find the high ranking shares? So the way I would do that, the easiest way to find higher ranking shares is go to browse, click it, and you'll find these preloaded screens. This is basically an area which gives you access to, yes, indices and sector data, as well as lots of our pre-rolled screens. So these are stock screens based on our ranking systems. And these are some of the more popular ones which are actually there available on that page. So if I was, for example, to go and look at the top StockRanks, I'll look at this one. This is the top quality and momentum rank. So it's a combination of quality and momentum. And when you click through, you get a brief description of what that screen is. You get the rules of how it was composed. So this has got a high quality and momentum rank, a market cap keeping the tiddlers out, and it's sorted by quality and momentum descending. And you've got a performance chart here. This is rebalanced every quarter, and we've been tracking it for many years. And if you've got an international subscription, which you can go and find more about international plans up here if you're interested in getting and adding more regions. But you can see that the performance has been strong. And then down below, you get all the candidate stocks in these lovely tables. And you can see Rightmove is actually the highest ranked quality and momentum share in the market right now. And if you hover over these stocks, you get a lovely card, which again shows you all the ranks and the key data, beautifully designed, and you can go and view, add it to a portfolio, etc. In the table itself, you can see the rank. Now, if you want to see all the stock ranks in a table, Sam, I'll show you that in a minute. This is a way to switch table views, and one of these you'll see is called ranks, and that will give you absolutely all the ranking data in the table itself. So you can see here's Rightmove, and its market cap, quality, value, momentum. We've also got a growth rank, stock rank, risk rating, stock rank style. It gives you all, that's the majority, like some of our best proprietary data in one view. And in others of these tables, for example, if you're a dividend investor, you can click income and you can go and analyze the yield and some of the quality metrics around the yield, like the dividend cover and so on, all in the table. These tables are all customizable. So if you click customize here, you should get a pop-up which actually shows you categories of ratio, financial ratio. If I was to click StockRanks, I could add one of these actual rankings into my table view. So this is where the columns live. I can confirm the column, and then I save the table, and you'll find them right here in your customized view. And so as you can see, the quality rank is actually there. So that's one really, really nifty way of actually doing that. I've actually moved it to the end. In your table views, you can also look at the charts of the stocks. I love this view because it really enables you to see lots and lots and lots of charts all at the same time. It's been a little bit slow because my internet connection is not great in this room, but you can see these charts. You can get 1 year charts, you can get 1 week charts, you can get 6 year charts, and eyeball them all. So if you're a trend investor and you want to find shares that are going up, or you're somebody who likes bargains, you can sort of analyze them at a glance. So I think those are pretty nifty features. Now, somebody was asking, how do I find high stock rank companies and sort by share price? Before I do that, if you are on these tables and you find a share that's interesting, what you can do is go and click the checkbox on the left of 1, 2, 3 shares, whatever you like, and click the button add to folio. So you might have a preset portfolio. I'm going to just create one and just call this demo folio, and you can click it, and it's going to be added to that, and I'll click add, and it's been added into a portfolio. This will take me through to the portfolios tab, where I can then see my demo portfolio, which really is like, at the moment it's a watch list because I haven't added it. I don't own these shares, but this, you can see the 3 shares are there underneath. And you can then obviously keep an eye on them, keep analyzing them. You can also add alerts from here. You can add alerts based on price changes, on stock rank changes, and more. Anyway, you also can add, so if you do own them, you can turn this into a fully featured transaction portfolio, but I'm not going to go into the details of that now. I wanted to quickly show you how you could screen for a stock with your own custom screen. So if you go onto screens and you click new screen, you can create your own. And here you'll just see a very basic interface where you can add a rule, click it, and I'm going to search by stock rank. Yep. Stock rank like that. Add the rule, and I'm going to look for shares ranked more than 95. And then I might add another rule, and I'm going to say, right, I want to find high ranking shares with a strong dividend yield. I search for yield, or I don't search for yield. I can go and look, use the categories, click dividends, click yield, add it, and there you go. I can find shares with a yield of more than 4% with a 95 plus rank. And there's 34 shares, which may well make a pretty, some of them are very, very high yield, and you might want to avoid the highest yield ones, but some of those could be very, very good performers. So as you can see, it's so easy to use this stock screener. As I said, you can screen across multiple countries at the same time, et cetera, et cetera. So that's that. Now, of course, you might not be somebody who likes analyzing shares using data. You might be somebody who likes analyzing shares based on the really fantastic analysis of others. If you are, you can go into the discuss tab. Actually, hang on a minute. I'm going to go and show you something. Before I go there, some people want to know, how do I know when shares are suddenly at a higher stock rank? And if you go on the today page, which gives you a briefing on the market, so we've got our editorial content here. We've got an overview of the markets, which are down at the moment again. And you can see here stock rank movers. There's a segment here. There's a chart here on the right, and if you click learn more, you can go through and actually see some of those charts that I showed you in the slides. But here on the stock rank movers, you can see there are some shares which have actually gone up to a 90 plus rank in the last few days. And you can click through to see them in a stock screen here. You can also see some of our proprietary classification, super stocks, high flyers, contrarians. So there's one new turnaround, Dixon's Carphone. There's 5 new super stocks. And, this is a great way to see the changes in the data. But if you are somebody who likes analyzing shares and likes getting the scuttlebutt on a share, you can go on the discussion forum. And for example, here's one that's been written by our absolutely prolific writer, Paul Scott, Paul and Graham, who write this small cap report. And Paul's, still being very, very prolific on today's market, analyzing Top Stars and John Menzies. And you can see this community underneath who've added lots and lots and lots of comments about all kinds of shares. You can see how many comments there were today just on this article. It's such an engaged community, and some of the best investors in the UK and internationally are actually engaged in this community. So, this is, I guess, a very great social validation of 70 comments today in a very, very difficult market environment. And it's a beautiful interface to interact with that. If you do find shares you like, when you're actually reading about them, you can use this wonderful thing in the sidebar, this card view, add them to the portfolio again, and add this one, Top Styles. It's a 98 stock rank, and add it to the same demo portfolio. And I'll get a little notification saying I have done. If I click through, I can go and see it there. Now, once again, this is a very, very quick overview of the site. There's so much more. Jack, is it a good system for retired people? I mean, fundamentally, yes, of course it is. You obviously have to structure your own process in a way that's aligned with the way that you need to invest. So if you are a retired investor, you might want more income. So you should use the yield features as much as you can and combine them with the StockRanks. If you go into the Learn tab, it's the last tab here on the left, you'll find a very, very in-depth guide into how to use the site, from getting started to using the stock reports. And if you click any of these guides, you'll get lots of articles. And you'll see little videos from me that are much shorter. This one's a 6-minute one. There's little videos from me and sometimes from others about how to use the different parts of the site. And, you can go in and, for example, if you don't know what the traffic lights are, you can click that. You'll get a little article all about it. We keep these up to date on every time that we do a new release. So they're always up to date. It's a great way to learn. If you want to know what's recently been released on the site, you can click what's new. And this is as I said, in constant development. So you can see this is actually the new version of the site, which we've been developing since July. And you can see we've done consistently these releases every couple of weeks. There's August, September, October, November, December, January, February. We're releasing lots and lots and lots of different features onto the site all the time. And this will tell you about the features that we've actually released recently. It's a great way to keep an eye on what's changing. And if you want to know what's upcoming in the future, there's the product roadmap. On here as well, you'll also find a ratio glossary. You'll find more links to our YouTube channel, which is the videos. So we've got an extensive YouTube channel with more in-depth webinars, a lot more videos and more. We keep that up to date. This webinar will probably go on there. And you'll see lots more speeches, testimonials, etc. too. And also all our ebooks. So we publish ebooks quite regularly, and because we've got this great editorial team, and you'll find lots of stuff to get involved in there, hundreds of thousands of words if that's your ilk. So anyway, that's my lightning tour of the site. What I wanted to do is just go back. Okay, you can watch the last bit later, Sam. I'm going to quickly just give you an introduction to, I'm going to show you a little bit more about the offer, and then I'll do Q&A afterwards. So the Stockopedia platform, as I said, it's all there. It's fantastic. You really got to go and dive into it to make the most of it. We've had fantastic subscriber results. We just completed another survey. It was about, it's only a proportion of our subscribers who did reply, but you can see that last year, the 60%, 73%, 72% said they outperformed or significantly outperformed the market. Only 6.8% of people said they underperformed the market over the last year. And it shows you really that we can add so much value to people's investment results. I think this is a great piece of information, and I'm really proud of it. The question I ask is, do you feel more or less confident in your understanding of the stock market since using Stockopedia? And you can see that 83% of people said they are more confident. And it's that confidence that we can help bring to your decision making that is one of the most fundamental reasons why people subscribe. We have consistently won the favorite share research platform. We've won for the last 3 years at the Mello Awards. We've won 3 of the last 4 years in the Shares Awards for Best Investor Research and Tools. We have this excellent rating on Trustpilot with more than 600 reviews. So we keep getting this validation from the market, from our community, and the community just grows and grows all the time. We've grown the community by I don't know 20, but quite a large proportion in the last year, and we've got this real momentum. And so I'd really like you to be part of it. We've got great investors. Okay, Robbie Burns, who is the Naked Trader. You may have read his book, Stockopedia. He is a great place to scan for new shares to buy. He uses it himself. He's gone even further than that. If you buy the latest edition of the Naked Trader, he's put almost a whole chapter in there about Stockopedia and graphics all the way through. He uses it every single day, and that's a great validation. David Stevenson at the Financial Times also giving us that sort of third-party validation of the quality of the service. So if you want to get started, and I think this could be one of the best investment decisions you make, please do join, and you'll talk to me in the oh, I didn't tell you about the support. There's a little green button at the bottom of the site. So if you're worried about, how do I use software? What do I, how do I actually get some support? Well, actually, if you go, and I should show you this again. Where is my Chrome tab? Yeah, here, if I just show you the site again. So down at the bottom right of the site, when you're on the site, you'll see this green button. And if you click it, you can actually talk to my support team. And you can start a conversation and go, hi there, I've got a problem. And hopefully one of the team will respond. It doesn't necessarily happen immediately, but you will get something from either me or from somebody else within a reasonable amount of time. And often we'll be right there at the time. Sometimes it can take a bit longer. But I've got CFAs, chartered financial analysts, and chartered financial analysts in training who do the support. So back to what I was saying. I wanted to just finish up what I was saying in my application window. Where is it? My entire screen. Let me go back to that. Hang on a minute. Where was I? I was here. Yeah, so how to get started. So remember what you get here. You're getting a decade of research into what works in investing. You're getting millions of pounds of platform investment, which have gone in by me personally and my other private investor shareholders. So there are no private equity investors. There's no VCs in this business. It's all motivated private investors who are all aligned with our own subscribers. We'll save you so many hours of research time because it accelerates the research. You get libraries of ebooks and research, great support, and a 25 strong, actually we're 28 strong team now, coaching you. And, if you were going to go and do this with an advisor, it would cost you thousands in fund and advisory fees. We do start at only $245 a year, but I got an offer which actually brings that down in price to a 25% reduction in your first year, which I think will really, really help. It's a very simple and easy to learn methodology. You've got a standardized research process, easy to use website, great learning videos. And as I said, my CFA support team are right there at hand. You can get started today. So Sam will share this link with you. If you're not on the chat right now, I'm sure he might do it now. He'll also share the slides with you. You can get a first year discount, 25% off the first year. We will not be discounting perpetually. This is something that we're actually going to phase out. So do take advantage of it. It just gives you that little bit extra off when you're still just not sure if it's for you. And you also get a 14-day trial. So there's really no risk. So go to /insight and sign up there. Andrew, we don't sell. So I'm going to now go into my Q&A. Sorry, I've got a bit of a bad throat today. So thanks very much for listening. That's 2 hours, 10 minutes. I hope I didn't take up too much of your time. I'm going to go through some of the questions, and I'm going to start at the earliest ones, and I'm going to work through them. And I'm going to see, remember, you've got that link. It's in the chat box. So you can go to /insight, stockopedia.com/insight, and you can go and take up that offer. So please do go and do that. And I hope I hope I've shown you enough of the value that we've got. And just go on the site, chat to people, find out about it, and really, obviously be careful in the markets. There's no guarantees, of what's going to happen in the next year or so. But this is going to be something that at your side, you're going to make much more confident decisions. There are so many people out there that go and buy these really, really spivvy oil and mining stocks and blue sky biotech stocks. And they have got speculative or highly speculative risk ratings, low rankings, and we classify them as sucker stocks or value traps or momentum traps. And the great thing about Stockopedia is you can systematically avoid those kind of shares. And if you do buy those kind of shares, you know they're a minority in your portfolio. So anyway, so Raz, I did put a percentage on high probability of success. I hope so. How much are data clear and correct? Well, Marco, we put our data is, I believe, and yes, I am biased, but it's the best on the web. There, you will find a lot of free data on the web, and free data is used for advertising revenue. You are not the customer. We have no advertising revenue. We only earn from subscription. Our business model is based on data, and if our data is not good enough, people cancel. The fact that we've got such a low cancellation rate by some of the most rigorous investors in the world, it shows how much of a premium I put on the data and my team does. We've actually got a new data system. We've invested for the last 2.5 years in a new data system that's coming out in a few months that has an even added level of rigor, which will actually even amp up the quality of the data even further. So, you know, you never are going to get absolutely perfect data, but you're going to get very high quality here. And it's probably, I know, because I know people who have access to Bloomberg and sort of professional terminals, and they've told me when they use this for their own personal investing that the data is better. So anyway, how many have too many shares in their employer? I'm sure too many do. Buying your employer's shares often leaves people very exposed. You've got your job there and your employer's shares. Shouldn't diversification / risk be a factor in the ranking? From Jazdeep. Well, what we actually do is diversification is actually a portfolio concern, and it really depends on the context. If you do buy another share, let's say a 99 ranked share, the diversification is against all the other shares in your portfolio. So I like to separate stock evaluation, which the StockRank is a measure of evaluation, from stock selection. And when you're building a portfolio, you should select shares in a good diversified fashion from the opportunity set that you've evaluated. So no, we don't factor diversification into the ranking. Risk is we actually separate that out into our risk rating. So we have a volatility-based measure of risk, which I will show you if I can in the application. I'm going to go back to the product, and if once again, if I was to go to look at, for example, BP. Let's go and have a look at that. You can see here that it's classified as balanced. So we have this risk rating that has a 5 measured, actually, I could show you and teach you more about the risk ratings in the Learn section, which should be somewhere in our StockRanks and ratings section. And if you just bear with me a minute, I should be able to find one of the articles about the risk rating. So it's down here, a risk rating for every stock. You can click through from stock reports. And there's also webinars about this. But we have these 5 measures of risk: conservative, balanced, adventurous, speculative, and highly speculative. And the conservative are obviously the least volatile, highly speculative are the most volatile. So we like looking at factors individually so that you can use them in a more structured fashion. So you want to basically be able to see that in your portfolio, you don't own all highly speculative shares. So if I was a conservative investor, I'd be looking for higher ranking, more conservative, balanced, adventurous shares, and I'd be avoiding speculative and highly speculative shares. It's a good way to think about it. So yes, we don't rank ETFs at the moment, but it's one of the key initiatives we're doing is to actually use our ranking system to rank funds and trusts and ETFs. So that's something that's pending and something we're working very, very hard towards. Dave, yes, you can screen for price to tangible book. So you can screen on hundreds of financial metrics. If I was to go and quickly show you how to do that, click screens, click new screen, add a rule, and you should get this pop up. You can either search for tangible book. Price to tangible book value is right here, or you can actually go into the value metrics, click here, and you can scroll down, and it should be price to TB, price to tangible book value. Add it, and you can look for stocks that are trading at a price to tangible book value of less than 1, or really cheap, less than 0.5. Can't find anything. There they are, 92 stocks. So it's very, very easy to do. So go and dig through the financial ratios. We've got so many of them. In fact, if I show you in the learn section, and if I click down here into the ratio glossary, you can actually browse all of our financial ratios in all kinds of different segments. So these are all the quality metrics we've got, and it's just an absolute goldmine of data. We've also got each of these measures in different time frames and so on and so forth. You've got growth metrics, earnings per share growth. We've got size metrics. We've got dividends metrics. If you love data, we've got bags of it. How much data history do we need to have before we can have an accurate QVM and StockRanks score? Well, Sam, we actually use 5-year return on capital measures. If I go back to Rightmove, if you do have generally shares that list have a few years of history. If they don't, if they really are a new listing and they don't have much operating history, I can't think of an IPO at the moment, but often they don't have the full 5 years. So we will create in our quality rank, this will go up to 5 years look back in terms of things like the profitability measures. But on a younger company that floats after 1 or 2 years, you will find that will be a little bit less reliable. Sometimes if it's a new float, we will put a disclaimer at the top saying that the stock ranks are only preliminary and you should do your own research. So do we have a podcast? No, thinking about doing it, would love to. Or a stocks trading for beginners course. I want to do that this year. It's one of my goals for the year. I'm hoping I can actually do it. I want to structure a stock market for beginners course and then actually seek into some of this stuff. Yes, Dave, our momentum score includes both price momentum and earnings momentum. If you do go and look down at a share, so I don't know, I'll bring up one. We've got a staff investment club, and one of the shares we bought this week, in fact today, was Billington Holdings, which is a very small cap share. And if I was to go and scroll down, actually, I hope this is a good example. I'm not sure whether it is. Yes. So you can see this one. One of the things I like to look at on stock reports is the analyst consensus. Now, there's only one analyst actually analyzing Billington at the moment, but this chart shows you the EPS forecasts and how they've trended over the last year. So this is 2019's the forecast for this year, for the last year just gone, and you can see that they've upgraded their forecast from 30 up to 36. There's been a 20% increase in earnings forecast. So that's strong momentum, that's strong earnings momentum. And we factor those things into our momentum rank, and that gives a higher proportion of it. If there's no broker forecast, then it actually falls back to just price momentum. Sorry if that's a bit advanced for anybody, but yes. Anil, does your system prove itself because investors invest in the top ranked stocks? So I presume you mean by that, has the rank gone up because people are using our system? I don't believe that's the case, okay? If you think about it, and I've done the sums, I think we are quite possibly influencing, we've got more than 10,000 subscribers, and we are influencing quite a significant amount of capital through the site and the subscriber base, but it's still a tiny fraction of the money under management by all the fund managers out there in the world and in the UK as a whole. So I don't believe that we're having that much market impact at the moment. So I don't believe that's the case. Certainly, if you look at the factor history and the academic research, you will find that factor investing has long outperformed. So Jazdeep, personally, I rebalance my portfolio. He's saying, on what time frame would you rebalance a portfolio? Personally, I would do it every year. I prefer to rebalance my portfolio quarterly, but only a quarter of it. So you don't want to trigger too many costs by rebalancing all the time. It can be expensive. Nick, the deciles, he's asking how regularly the deciles are rebalanced. And I can show you that. You can go on and play with this. If you go into the StockRanks section in the Learn area and you scroll down, you can actually change the rebalancing period. And yes, you're right. If I go and choose, you can see here for quarterly rebalanced portfolios, it's about 170%. But for annually rebalanced portfolios, it will be significantly less. So, and then that becomes 144. So, you still see the spread, but for annually balanced portfolios, you don't see as much outperformance. That does not mean you should go and rebalance your portfolio every quarter. It just means that, and obviously your own rebalancing period depends on the kinds of shares you own. It depends on the size of your capital, depends on what transaction cost you really can deal with. It also depends on your tax status. And as I said, this is for self-directed investors. You've got to make your own decisions. When you are looking at trading a share, if I go back and look at Rightmove, one of the things I like to look at is the spread. So if you go back to stock report, you can get the full quote by clicking this little link here. So hang on a minute, click for full quote. It's being a little bit slow. There it is. And you can see the spread here is only 3 basis points. That's tiny. It's like 3/100ths of a percent. 100 basis points is 1%. So if it's a liquid share, if it's a large cap, you're going to have very low frictional trading costs. In the UK, you've got a stamp duty cost, which is a tax. Other countries might not have that. But in small cap shares, you might find the spread or the difference between the buy and sell price is much, much, much larger. So, you've got to keep an eye on that. I like to not really buy shares that have more than a 2% spread, but that's just me. If I was to go back and look at, Billington Holdings, and as I said, I do own this share as part of our investment club. So just full disclosure there. But if you were to go and look, and there's another place you can actually see it is at the bottom of stock reports. We actually have it here. The spread is 155. So that's a 1.5% spread. So if you're dealing in that, you're going to have some frictional costs. So don't, rebalancing and trading too often can put you at a disadvantage. Performance. Okay, I'm just going to go just try and breeze through these. I'm conscious of time. Yes, you can create your own screens. I showed you that. I've shown you that. We have intraday prices, not real-time prices. So they are 15, 20 minutes delayed. That's an important factor. Can we rank indices? Well, I can show you what we do. If I go to browse, you can go into browse and click indices, and you will get some, actually, no, there's no average stock rank on the indices, but I believe we do it on the sectors. You can see and actually sort by StockRank and so on via sectors and see which ones are generally cheaper than others. You can see here that healthcare has a lower average stock rank than others and tends to be more expensive. So that's something you can go and dig into if you like. Yes, Dave, our major shareholders feature is new. It is up and it's great. I love this feature. We've had fantastic feedback. We released it and we got lots of feedback from the community, and then we iterated on it. On stock reports, you can see here shareholder activity, institutions, and you can see some institutional buying and selling, and you click view and you'll go through to this major shareholders page and you can see who the biggest shareholder is. So this guy, this investment management firm owns 8%. And a subset fund of that owns 4.5%, and 50% of this is owned by the top 10 holders. So we show the top 10 holders. It's downloaded every day. This comes from Thomson Reuters or Refinitiv. It's a really fantastic database, and they update it all the time. And you can often find, like the last report here was February the 5th. There's some here from that was Feb 5th on 2020, and it's brought in from all kinds of different sources. But it's a great way to find. Abe, sorry, we don't have a team that manages retired people's portfolios. Maybe we should. In terms of us actually adding an advisory service, it's something we often think about. We do. There are professional traders who use our site. We're being asked by Andrew if we have professionals who use this, but it's not currently a B2B product. But there are people who trade full time as private investors who use it. And let me see, are there any others that I want to just jump to? Yes, we track net current asset value. You can add that as one of the table fields. Investment trust will be added first. Adrian, it's probably not in the next 3 months. The next 3 months, we're adding our new data system, which is designed to facilitate the addition of the investment trust and funds data. So it's going to be the first project after that data system is in. I don't have an exact time frame at the moment, but it is one of the most important things on our radar. So anyway, Robert, you can use it to select shares for options trading, but we don't have options details on the site, I'm afraid. And no, Maureen, the stocks are not all UK. You can do exactly the same thing. I'm not sure where you are, Maureen, but for example, I'm married to an Australian. My father-in-law is Australian, and I can go in and browse the site for Australian shares. Here we go. I can go and look for Australasia. It is more expensive to add more regions to your subscription, but you can see here the top rank share. Here you're getting it for free. Top rank share in Australia is Shaver Shop, followed by Fortescue Metals, Shriro Holdings, XRF Scientific, and Warehouse. So there you go. We've got a range of regions, and we're adding more all the time. So thanks, guys. Yeah, thank you, Dave. Yes, very informative. It is a great product for private investors. I love it. Also, you can get it on your phone. So let me just show you this. If I was to actually make the screen size smaller, I hope that this will reformat without me needing to reload. So if I do go and, like, let's say, look at Rightmove again, and I search for that, I might need to refresh the page. But on your phone, it will look more like this. So, you know, you're going to get the same features, and you can add it to your home screen. So, for example, you can go on, you can read all the blogs, you can go and click through to the stock pages, and you know you'll get it all on your phone as you go. And it's really, really beautifully presented. Slightly different design on the phone, but great. Right, I'm going to stop that now. It's been an hour and 25. Thank you so much for sticking around. Once again, if you do want to take a subscription trial out, please do go to /insight. And I really hope that I've given you enough information to be able to make that decision. Any questions, just ask the support team. Click the green button. I might be around. I might answer it myself. I do quite a proportion of them myself. I try and do about 10-15% at least of the support issues personally, because it's the best way to know what the problems are that people are having. And you know, any other issues, just let us know. You can talk about the features. You can have any queries about pricing or any queries about anything that you can't find, just let us know. And also, we'll let you know about all our development roadmap and what we've got planned. Next door, I've got the team of developers are in there and doing the data and support and marketing and all the rest of it. So we've got 28 staff here and in India and in other parts of the world. And you know, we're really here just to serve you. I'm just trying to make this the very, very, very best service for private investors on the web. So thank you very much for listening. I hope to see you online, and please do take advantage of the offer. All right, I'm going to stop now. Take care.